or welcome back to my channel. I am Prerna and I'm on a mission to make India talk about money without any taboo. Today we are going to talk about equity and bonds or a debt mutual fund. If you want a detailed video on a mutual fund, I've already made that. I'll leave a link here. You can watch it after this video. Today we are going to talk specially about the difference between equity mutual funds and a debt mutual funds. So let's begin. Okay, let's begin. Let's first understand when I say we have invested in an equity mutual fund, what exactly happens, and when I say we have invested in a debt mutual fund, what exactly happens. Let me explain this to you with an example. Suppose I and my friend, we both have started a company, and this company has a 50-50 partnership between both of us. Now, if any loss happens, the loss will be equally divided between both of us, and if any profit happens, that profit will also be equally divided between us. That is exactly what happens in an equity mutual fund. When you buy a equity mutual fund or when you invest in an equity mutual fund, you technically buy a certain percentage of share in that particular company. Now you become a shareholder or share owner of that company. So if any loss will happen, that loss will be yours. If any profit happens, that profit will be yours. So when you invest in an equity mutual fund, your profit and loss is dependent on that company or is dependent its position in the market, the position of that company in the market. Whereas in a debt mutual fund, exactly as the name suggests happen, that is a debt. So a company says, I have enough shareholders, I have enough partners, I don't want any more partners, but we want money. Now how will they raise money in that case? What they do, they take a loan from a general public. Now what they offer in return, they offer a certain fixed sort of percentage in return. So when you invest in a debt mutual fund, you are technically lending to a company against which they have promised a certain percentage of return. So in equity mutual fund, you become a partner, you become a shareholder, you become an owner. Whereas in debt, you do not become any partner, shareholder, owner. You have just given a debt. The way bank gives you loan, similarly you have given a loan to a company and you will get a certain return out of it over a specific period of time. Okay, so now that is clear, that the entire concept is out of our way. We'll see the difference, what exact difference is there between both of them under certain parameters. So number one parameter is risk. So in equity, as I have already said, it is market dependent. So in a short term period, the risk is certainly high because you don't know how market will perform tomorrow. But over the period of time, as you have already earned certain returns, the risk becomes moderate. Where in a debt mutual fund, the risk is quite low because a company promises a certain part of return, certain percentage of return. So even in a short term or in a long term, the risk category is quite low. So number two category is return. Generally, if you compare the returns in equity with the returns in debt, equity is generally on the higher side. Why? Because whenever there is a higher risk involved, there are chances of higher returns. But these higher returns are not guaranteed always. Remember that these are always market dependent. But yes, there is a potential, there is a probability of getting higher returns in equity as compared to debt. Whereas in debt, you get an average return about 7 to 8%. Sometimes in some bonds, it does go to 8 to 9 to 10%, but generally it revolves around 7-8%. Okay. Number three is liquidity. First of all, we'll understand what does liquidity mean. So liquidity means nothing but how accessible or how easy is it to get your returns or money back from the market in case you need it today or tomorrow. Okay, so suppose you have invested in an equity mutual fund. Now you know that equity mutual funds are linked to the market and they are at the high risk. Today the market is not performing so well and your returns are lower. In that case, if you withdraw that money, you will get lower returns. So I can clearly say or confidently say that the liquidity in equity mutual funds is lower. If you want to withdraw it like on a particular date and market is not performing well, you cannot do it. Whereas in a debt mutual fund, you can withdraw money at any time. They are highly liquid because they give a certain fixed kind of rate of interest or rate of return to you. So number four is volatility. Basically, volatility means how much volatile or how much fluctuations are there in your return in particular kind of mutual funds. So we can say in equity mutual funds, as they are entirely dependent on the market, they are highly volatile. One day they can be really high and other day they could be on the lower side. Whereas debt mutual funds, they give you a consistent return, they are not market dependent. In that case, they are very low on volatility. So a very next question comes, which is the most common question I get on my IG, is that where to invest and when. So very first thing which I am going to discuss is a thumb rule which everybody generally follows, and then I'm going to talk about what I personally think where to invest and when. So thumb rule says whatever your age is, that percentage of your investment should go towards debt and remaining should go towards equity. Okay, for example, your age is 25, so 25% should go towards debt and remaining 75% should go towards equity. Now if somebody is 50 years old, he should invest 50% in debt and 50% in equity. Although it is called a thumb rule, it is not a strict rule which you need to follow. It is just a guideline, and it's not like that if you're not going to follow this rule, you're not going to make up profits in the stock market and you have to strictly adhere to it. It is just a guideline. Also, your investment depends on your disposable income. So what do I mean by disposable income? The income which is left with you after making all the expenditures, like paying towards your loan, buying groceries, and paying your child's education and everything. Whatever income is left with you, it is known as disposable income. Now if this income is sufficient enough, then you can follow this rule, this thumb rule. If it is not sufficient enough to follow that thumb rule, you can make an investment according to your risk appetite. So now we'll come to a point, where do I invest to prefer my money, whether equity or in debt, and when. So I generally suggest people to invest in debt for a short term goal. So always keep your goal in mind when you are making an investment. So if it is for a short term goal, it should be in a debt, and if it is for a long term goal or medium to long term goal, it could go towards your equity. Now all these long term, short term goals I have explained in this video, you can watch that. The reason for that is very simple, because your equity fund is high on risk, it's not very liquid, it's highly volatile. So you do not want to withdraw that money immediately in case of emergency or for a short term. But as the time passes, that risk factors lowers. In that case, for a longer period of term, that's why we say the risk is moderate. That's why if you have any goal for next 7, 8, 10, 15 years, like for your child's higher education, for buying a house maybe in next 20 years, for that all thing you can invest in equity. But if you are planning to buy a laptop in next 5 months, a car in next 1 year, for that you should invest in a debt fund. Okay, so both in equity mutual fund and debt mutual fund, you can invest either in the form of SIP or in the form of lump sum. I have explained the details entirely, what is the difference, how you can invest in this video, so you can watch that video. Meanwhile, if you like this video, give it a big thumbs up and subscribe to my channel. I keep coming with these kind of videos. Until next time guys, take care, bye bye.